Welcome everybody on the first workshop of the Symposium on the socialization of the banking sector and debt. This workshop will deal with the causes of the banking and sovereign debt crisis in Eurozone and European Union in general, and in the Eurozone and EU periphery and Slovenia in particular. So this workshop will address more general issues. The discussion will be maybe a bit more free, whereas the other two following panels will be much more focused and will be aimed at finding concrete solutions for basically saving the problems of the banking sector on the one hand and saving the problem of the sovereign debt on the other. So we will start this workshop with two brief presentations. Ms. Laužitko will be talking about the crisis in the Eastern European countries, while I will present a brief paper on some of the macroeconomic trajectories in the Slovenian economy in the last 20 years, but we will be brief and note that these workshops are basically not intended to be classical panels where first we have presentations and then the public only poses questions to the speakers. We are rather aiming at a more collective discussion with as much participants as possible, and I would specifically like to encourage all of our guests from abroad, namely Michael Roberts, Stefan Kirschel, Dimitris Liakos, of course Ms. Laužitko and Nick Brooks, to interrupt you and to take part in the debate. So I would like to ask Ms. Laužitko now to present his introductory.
Okay, thank you, and thank you for the invitation. I'm just going to give you kind of highlights of what I think is important when you look at Central and Eastern Europe as a region. Of course, there are a lot of differences, but recently in the varieties of capitalism literature, this region was labeled dependent market economies. That is how some scholars perceive this entire region, as a dependent market economies, and there's a good reason for that. I think indeed this region is dependent, and it is dependent on foreign capital in various forms. So when you focus on period between 2000 and 2007, so right up to the beginning of the crisis, what you can see actually is that this region has experienced large capital inflows during these years, and of course this all happened in the context of building up the Eurozone and in the context of financialization. So during this period, new capital inflows were present in these countries, and I think what distinguishes the period from 2000 to 2007 from the 1990s is basically the change of composition of these inflows. So in the first instance, these were all foreign direct investments, and that is something you can see when you look at data on bank ownership. So the question is, who owns the banks? Well, in this particular region, the banks are largely in foreign ownership, up to 90%, 95%. Of the banking sector is owned by some parent bank in the advanced capitals countries of Europe. So that is why at first we had foreign direct investments. That was the dominant type of capital inflow, and later on we had mostly portfolio investments and other type of investments, investors who put their money in government debt or other kind of debt instruments. As I said at the beginning, we of course need to pay attention to country-specific factors which stimulated and determine the composition of these inflows. But this is kind of general. This is kind of a general story. Now, what is I think important from the left position is that these capital inflows were, of course, and are still connected with macroeconomic imbalances. So it is from the left position, I think, key to understand that when you have large capital inflows in a country, the government and the central bank as a monetary authority needs to react to those inflows. Now, from the neoclassical point of view and from like general or mainstream economics point of view, this type of financial liberalization and rapid financial deepening will of course be hailed as something that of course increases the efficiency of the banking sector as a whole, and also it will be hailed as a positive aspect for the overall economy, because this foreign capital will now play some kind of, that is the general idea, will play some kind of productive role in these countries. But the fact of the matter is, when you look at the official data, is that these capital inflows, once this surge of FDI was over, was actually used for rapid credit expansion. And that means that the investments are not, were not placed in the productive sector. No factories were built. There were no kind of expansion of productive capacities. But these capital inflows were used to extend credit to a large extent to the household sector. And so we have kind of a general tendency across the board of rising household debt. And this is of course very important from the macroeconomic point of view, because this rising household debt means that the country is now able to create demand. But the goods that are being bought and sold are not the goods produced within this region. These are goods that are imported from abroad. So with these large capital inflows, we have also current account deficits, and that is also one important feature of this region. So indeed, it is true that one can perceive the Central and Eastern European region as a dependent region. It is dependent on foreign capital. It is dependent in macroeconomic sense, because without foreign capital, the demand cannot be sustained. And so the growth rates, which were largely due to consumption, could also not be sustained. And this is what we saw after 2007, when we experienced basically the end of this story with sudden stops and in some cases capital flight. And what happened after 2007 is basically the households were left without the basic means for expanding their consumption, namely credit, and they went into this deleveraging process. And non-financial corporations did somewhat the same. And this is the reason why we had such a prolonged recession in this region. Much more in some countries, much more sharper than in other EU member countries. So the thing that I think needs to be emphasized is this link between capital inflows and overall economic performance in these countries. And the other thing the second point that also needs to be emphasized is the fragility of the economy that came about as a consequence of this type of development model, if you will. And so, of course, there are different patterns of fragility, but one of the major problems for several of these economies, like Croatia, Hungary, and Poland, was, of course, high degree of Eurozation, both credit and deposit Eurozation. And this came about, of course, as a consequence that banks, the foreign-owned banks, prefer to lend money in foreign currency. Why? The interest rate differential. So households were actually engaged without awareness in this, what is known as carry trade activity. So banks were able to exploit the interest rate differentials. They will lend in a country with low interest rates, and then they would borrow at low interest rates, and then they would afterwards lend in some of the Central or Eastern European country with high interest rates. And of course, for some households, this seemed at that point in time like a good deal. So for instance, when households were offered loans in Swiss francs in Croatia, Hungary, or Poland, they thought, yeah, this is much cheaper than loans in euros. But after the crisis began, we saw how interconnected financial markets really are, and how banks were able to transfer the currency and credit risk onto the households once the Swiss franc appreciated back in 2010, I think. And so what we actually have in this region is not a banking crisis, but a household crisis as the end result, I would think. The ironic result of this overall process of really moving these large amounts of capital across the border is actually an economy in which the banking sector is the most solid part of the economy. Why? Because households and non-financial firms are heavily indebted, because markets are underdeveloped, usually underdeveloped in these countries, so non-financial corporations can only borrow from banks. It is very difficult to kind of put forward your own, say, commercial papers or other type of financial assets. So we have some kind of quasi-Hilferding model developing in Central and Eastern Europe. Really a combination, an amalgam of finance and productive capital, with banks having the upper hand in this case. And this is extremely important fact for the left, in as much as the socialization of the banking sector is a problem that needs to be addressed, because it is very difficult to find political rationale to do this. I mean, except for the outright expropriation. See, banks, I'm now having in mind Croatia and Hungary and Serbia and also Czech Republic. The banks are quite solid. I mean, during this initial period, in some cases the central banks made a very high reserve requirement for these banks, in fear that, you know, something could go wrong. And so the banks are actually floating in this liquidity, and they don't have any place to put it. That's their problem. They have too much money, too much stuff. Now, of course, after 2007, with this major deleveraging of the household sector, that they did start to lose profit, but that didn't change the overall picture. This is still quite profitable activity, and so yeah, they will complain, "No, we are not profitable as we used to be in the high days of 2000s," but that's life. So this, I think, this is a structural problem which I think poses a problem strategic problem for the left, whether in systemic terms or in more pragmatic Keynesian terms. In systemic terms, the problem is that this is a highly financialized region, but the banks, the decision making, and the strategy of banks is made someplace else. So there is no democratic accountability whatsoever of this segment of the economy, and of course the central banks have very little leverage compared to the private banking sector, and we saw this with this capital inflows as the central banks were performing sterilization operations in order to kind of countermand or neutralize these inflows that could cause damage to exchange rate, which is in some cases used as a monetary anchor. And these sterilization operations, Daniela Gabor made this very fine analysis. They offered this almost risk-free, short-term, very profitable outlet for the banking sector. And the central bank couldn't do anything about it. The Romanian central bank tried and failed miserably. So this is the I could say a systemic part of the problem. And on the more pragmatic part, or on the more pragmatic aspect of the problem, is what to do. What to do about this inability to influence banking sector in terms of lending money to some kind of productive activity that could stimulate employment and generate perhaps a new type of development model. It is, as I said, very difficult to even propose socialization of the banking sector. And the other option, the other alternative is, I think, creating perhaps a special banking units in state ownership that would be exclusively concerned with productive lending, or supporting through legislation and other means what is known as ethical banking. Now, I know that this sounds a bit flimsy, but there appears to be in several of these countries a large segment of very small enterprises who were perceived to be very risky borrowers by this banking oligopoly, and they were left without any credit lines. And so this could be a way, this could be a channel to really stimulate and to put forward investment in type of activities that could generate domestic employment and domestic demand without further aggravation to the current account. So these are, of course, just kind of preliminary points. The underlying point is that the situation is quite difficult and quite complex, and I think that all of these countries suffer from what is known as pair dependency. Now a structure has already been created, and it's very hard to remove it, at least in the short amount of time. But nevertheless, for an active left in any of these countries, be it Bulgaria, Croatia, Romania, or other European countries such as the Czech Republic and Slovakia, left needs to be capable of addressing this on a pragmatic level, that is on a policy level. We need to be able to offer some kind of alternative program or alternative solution that would not be recycling more of the same, and that would in turn stimulate policymakers to move away from this export driven model, which has proven to be quite dangerous for the post-socialist region as a whole. Thank you.
Okay, thank you, Mislav, for your presentation. Now I will continue with my presentation. As I already mentioned, I'll present a brief depiction of the trajectory of the Slovenian economy in the last 20 years, and for analytical reasons I will divide this 20-year historical span into three periods, namely the period of domestic accumulation-based growth from 1994 to 2004, the period of debt-fueled growth from 2004 and 2008, and the period of crisis lasting from 2008 till this day. So I will focus on the process of accession of Slovenia to the ERM, the European Exchange Rate Mechanism, Eurozone and the EU, and highlight some of the most problematic macroeconomic shifts witnessed by Slovenia in the wake of European integration. So to start with the first period from 1994 to 2004, after a period of a sharp recession and high inflation in the early 1990s, Slovenian economy witnessed a recovery and entered into a period of relatively decent economic growth and relative macroeconomic stability. So from 1994 till 2004, the average real rate of economic growth was around 4.1%. The sovereign debt was very low, never exceeding 30% of the GDP, while the foreign debt of the state was also rather small. And the current account in this period stayed roughly in balance. But even though after 2002 the current account deficit did start to rise gradually. But the development of the Slovenian economy in this period was largely based on domestic accumulation of capital and on the facilitation of the export-oriented domestic corporate-based. Financing of investments in this corporate sector was based mainly on bank credit, which made the corporations much less dependent on the whims of capital markets. And this kind of growth reflected, amongst other things, a specific balance of class power, namely the strength of the emerging domestic bourgeoisie, reflected basically favoring this domestic accumulation of capital over foreign capital-based accumulation. And moreover, the organized labor was able to prevent, to a certain extent, the implementation of the continuous demands of foreign investors to loosen labor regulations, to cut down wages, to dismantle the welfare state, to release the tax burden, and so on and so forth, and thus to create a favorable environment for foreign direct investments. So, thus one of the specificities of Slovenian economy in this period was that it was less reliant and dependent on foreign capital. Also, the inflow of FDIs was very restricted, and for several reasons, mainly the privatization process in the early 90s facilitated internal buyouts. It favored domestic owners over foreign owners, and the strength of the organized labor was reflected also in relatively high wages. This made the country much less attractive for foreign investors, and the last but not least, also the policies of the central bank aimed at preventing the appreciation of the tolar, the Slovenian currency, before it adopted the euro, basically limited the inflow of speculative capital, and thus contributed also to a limited inflow of foreign direct investments. And the second specificity was rather unconventional exchange rate policy, namely in Slovenia a floating exchange rate was adopted. The Bank of Slovenia could thus follow a policy of controlled depreciation of the currency, by means of which the competitiveness of the export sector was facilitated without the need to resort to policies of internal devaluation. And a result of such policy was a bit higher rate of inflation, but it seemed that the policymakers were actually prepared to accept the risks of a bit higher inflation for the sake of higher employment and economic growth. And the third specificity was, and basically still is, a large share of state ownership of the economy. Three of the biggest and strategically most important banks are state-owned. The same goes for the public infrastructure and the biggest and strategically most important enterprises. But this kind of development I spoke about from 1994 to 2004 basically allowed also for some concessions for the Slovenian working class, namely the real wages were actually constantly rising while unemployment was falling, and furthermore the minimum wages and unemployment benefits in Slovenia were amongst the highest in the post-socialist Eastern European countries. However, after 2004, Slovenia witnessed a shift, a shift from this domestic accumulation-based growth to a debt-fueled growth. And this shift basically coincided with the process of Slovenia's accession to the European Union and the European exchange rate mechanism in 2004, and its later accession to the Eurozone in 2007. So from 2004 to 2007, Slovenia witnessed an economic boom with accelerated economic growth. GDP growth reached 7% in 2007, and investments, especially in the construction sector, started to soar. Yet this course of development was only made possible by an unprecedented growth of credit. And in only 4 years, from October 2004 till October 2008, Slovenian foreign debt rose for 24 billion euros, which is almost twice as much as in the whole previous history of Slovenia. Namely, after 2004, Slovenian banks started to borrow extensively from abroad. And not much of this credit was directed towards the households. The household debt was and still is one of the lowest in the EU. In Slovenia, the vast majority of bank credit went to the corporate sector. And the average growth rate of credit to the enterprises between 2005 and 2008 was around 23%. So the corporate debt was at around 100% of GDP in 2005 and reached 144% of GDP in 2010. That is highly above the EU average. And it is rather clear that this boom of the Slovenian economy based after 2004 was based on large-scale credit growth, basically growth of credit acquired by Slovenian banks from abroad and directed towards the domestic corporate sector, particularly towards the overheating construction sector. So the root of the problem, as was already mentioned yesterday by Michael Roberts, thus actually lies in the corporate sector. And to a certain extent, this shift from domestic accumulation-based growth to debt-fueled growth can be contributed to the process of European integration. This massive inflow of credit to Slovenia from 2004 to 2008 was definitely speeded up by the entrance of Slovenia to the IRM2 and later to the Eurozone, since the process of accession contributed to the convergence of the interest rates towards the level that was prevailing in the Eurozone. And this also enabled the Slovenian banks to get access to cheap credit from abroad and caused a shift in bank financing from deposits to foreign capital markets. So in 2005, the loans to deposits ratio was around 1, while in 2008 it grew up to 1.6. So this shift made the Slovenian economy much more dependent on foreign capital. And another important reversal after 2004 was, of course, a change in monetary policy, a direct consequence of the adoption of the euro. Already before, as soon as Slovenia entered the IRM2, it had to peg the dollar to the euro. So the pegged exchange rate ruled out the possibilities of central bank policies aimed at controlled depreciation or prevention of appreciation of the dollar, and basically the possibility to facilitate exports by means of devaluation of the currency were thus ruled out. So the only remaining option was that of internal devaluation. Furthermore, Slovenia was of course forced to issue its debt in a currency that was beyond its control, which made the country again much more dependent on the whims of international financial markets. And not incidentally, during this period, the export sector started to lag behind in terms of competitiveness, and the current account deficit started to rise. So in January 2004, the current account deficit was only 2.4% of GDP, whereas till 2009 it reached 6.1% of GDP. And when the Great Recession hit the global capitalist economy in 2008 and 2009, Slovenian economy witnessed a sharp fall in export performance. The exports decreased by more than 16% in 2009, and there was also a devastating decline in economic growth. GDP dropped by 7.9% in 2009, and also the inflow of cheap credit gradually started to grind to a halt. Also, the bubbles in the construction and real estate sector bursted. So, at the same time, unemployment started to rise rather swiftly from 4.4% in 2008 to an unprecedented 9.6% in 2013. And the living standards of the Slovenian working class started to deteriorate accordingly. So the highly indebted and leveraged corporate sector was caught up then in a rather unfavorable situation of diminishing credit flows, and as construction and real estate bubble burst and losses soared, and the enterprises' assets also devalued. And since the enterprises were largely financed by bank loans, these losses of the enterprises accumulated on the balance sheets of the banks in the form of basically non-performing assets or non-performing loans. And in 2010, the situation was made even worse when the Central Bank of Slovenia increased the capital requirements for the banks. So this contributed to a further contraction of lending activity, and the credit crunch pushed many enterprises into bankruptcy and aggravated the losses on the banks' balance sheets. And after that, the amount of non-performing loans on banks' balance sheets rose constantly till the end of 2003, when it reached around 8 billion euros. But okay, right now they're solving the problem with the so-called bad bank that has already taken over more than a million euros of bad loans from the two biggest banks, and it is about to take over 3.3 billions of euros of debt overall. So the sovereign debt crisis that followed this trajectory was basically a logical outcome of the recession and the crisis rooted in the corporate sector. So before the eruption of the crisis, as already mentioned, the sovereign debt was very low. In fact, the government debt to GDP ratio fell from 27.4% in 2005 to merely 22% in 2009. Yet after the recession in 2009, it started to skyrocket. So it reached 35.1% of GDP in 2010, 47% in 2011, and currently it's estimated to be more than 27% of the GDP. And the increase of sovereign debt was mainly a result of declining tax revenues due to a fall in economic activity and the parallel rise in welfare spending due to rising unemployments and deteriorating living standards. So the sovereign debt also rose due to government interventions into the banking sector. So mainly in 2009, the government mitigated the problems of liquidity in the banking sector by increasing state deposits in the main Slovenian banks, and later on in 2012, further bank recapitalization took place. So this Slovenian sovereign debt crisis was aggravated after the turmoil in the Eurozone in the second half of 2011. In November 2011, the yields on 10-year government bonds rose above 7%. They also exceeded the 7% limit yet again in January 2012 and in August 2012. So the most critical period is over for now, since the yields on 10-year government bonds have fallen recently. However, insofar as there are no prospects for growth in the near future, and seeing that problems in the corporate and banking sector are far from resolved, there are basically no indicators to suggest that sovereign debt will start to shrink anytime soon. So this will be it from my. So now we will start with the discussion. So first, if anyone has any questions for Mislav or for me concerning what was said in the presentation.
Perhaps just towards the end of your presentation. So what is the situation of the corporate sector now? Is there a strong credit crunch? Or what are their access facilities to loans at the moment?
Yeah, I mean, the situation is still, I mean, it's not getting resolved. Some of the basically assets of those enterprises in the corporate sector were also accumulated in the form of bad assets in the bad bank. So these were also basically taken over by the bad bank, and thus also, I mean, this was done to have to mitigate the situation in the corporate sector, but nevertheless not much progress was made in terms of, I don't know, reasonable sanation of this sector or anything like that.
If I may, to Philip's question, yeah, the credit crunch is still lasting, and the rate of credits is still falling. It's been falling since, let's say, second half of 2010. Okay. So, for various reasons, of course. On the one hand, you have banks that are not so prone to lend anymore, obviously, because of the catastrophe before 2008. And on the other hand, you have manufacturers, you have companies which have diminishing income. That was the case in the first part of the crisis. And then you have, of course, highly indebted enterprises who also do not have enough assets to leverage their new debt, because in times of crisis the asset prices fell, so you have less leverage. So yes, the credit crunch is still the major factor, and the bad bank is not a solution. Nobody actually even pretended that it was, because the bad bank solves certain problems for the banks, but it is not a bank. It does not give credits. It does not lend to anyone. So of course, there has been a lot of recapitalization. There's been a lot of money thrown into the banks at the moment. There is a lot of liquidity, but I would say because of the limits on the demand side for loans, the credit crunch is still the major problem. And of course, the government is trying to alleviate it, trying to do something about it, like considering, for instance, warranty schemes for the loans, which it did implement at the beginning of the crisis in 2009 in a rather limited extent, too late and not well worked. So it did not work too much. So yeah, that's pretty much the picture in this sense.
What struck me from both your contributions was that the crisis in Slovenia is very similar to Ireland, in that it wasn't a crisis where households got over indebted, and like in the States, and the banks found that they had people who wouldn't pay back their mortgages. It was that companies, construction companies, developers, real estate operations, developing all sorts of things that probably didn't need to be developed, were the things that got in the corporate sector that got into trouble. I'm not clear, perhaps you can tell me, whether manufacturing or the other productive sectors of the corporate sector were also getting into bad debt situations or not, or whether it was the real estate unproductive sectors that were expanding because of, as you explained, the carry trade, cheap credit wasn't just carry trade for cheap credit for households to get foreign loans, but also corporations, particularly in the construction area. And that's a big boom area where politicians can offer planning permissions in order to enable that process to go through. So that the crisis was there, and this is very similar to Ireland, because what the Irish banks had lent basically to developers and building companies, not to households, they did mortgages, but the crisis was there, and they had sweetheart deals with them and all kinds of other corruptive activities by which they made a lot of money. And when the crunch came, the Irish solution was to set up a bad bank and eventually shift all those bad debts of the developers into the bad bank, which had to be paid for by state money at a discount, 40%. I don't know what the discount is for the Slovenian bad bank. I think it's about 60% discount. It's quite large, isn't it? The object being that if you make a big enough discount, then the taxpayer will get their money back if they can sweat those assets or sell them on. Whether that the Irish bad bank had a projection of 10 years to achieve this, where they claimed that they were going to break even after 10 years. They started in 2009, 10. So at the end of this decade, they claimed that they will have sold off all these assets and broken even for the taxpayer. That remains to be seen. I don't know what the projected position is for the Slovenian bad bank, if it's the same model, which it suggested is the same model to me. And that one of the features of the bad bank in Ireland is that, so it's taxpayers' money locked up for 10 years, or either the bad bank issues bonds in order to raise funds to buy the assets or more assets and then sell them on. Trying to avoid fire sales so they make a loss, but they're not sure they can do that, to try and cleanse the corporate sector of this debt and put the banks also back on shape. One of the Irish bad bank is faced with developers who, first of all, fight them in the courts, because it basically means taking over those assets, because the bad bank in Ireland now owns half of London, because a lot of the developers in Ireland had expanded into the Battersea Power Station. There are all kinds of things in London. The UK assets that they've been developing were quite large. And they were easy enough to sell off first, and they had some American stuff and all kinds of things. But eventually they got left with all these housing estates and business parks in Ireland that nobody can do anything with. They're empty. So, but the developers fought this in the courts, and then they didn't want to service it, and so the bank is actually left with people often occupying these premises that they have to try and get rents off. So they become managers of landlords. So the whole process becomes incredibly complicated. To ensure that it works, the Irish bad bank has hundreds of people working in the bad bank at exorbitantly high salaries. The head of the Irish bad bank is on more money than the Prime Minister or anybody else. He's on a huge salary in order to turn this around eventually for the taxpayer. This is the solution to this cleansing process. It sounds to me, you told me, that it sounds very similar, that Slovenia is getting into the same situation. End up with a load of assets which it's got to try and sweat or sell in order to break even for the taxpayer, having injected a considerable amount of money fiscally from the Slovenian taxpayer or borrowed it, raised the bonds to do so, and faces a long process of trying to clear this away.
And there is, would you like to say something before? I think so. Yes?
Shall I stand up? It's just, can you hear
Whatever you prefer.
Okay, I'll stand up if you can hear me more clearly. I think a useful model to look at this economic crisis is to look back at Kindleberger's fairly classic book, The World in Depression, which is about the 1930s. And there can be all number of triggers for an economic crisis. We could say it's a stock exchange collapse in October 29 that started the Great Depression. We could say equally that the banking collapse was the trigger for the Great Depression of 2008. But the underlying causes are deeper than that. Kindleberger makes the point that the main collapse in output was a collapse in investment in the advanced capitalist countries. And that's the case today. I mean, in Britain, living standards, that is consumption, remain lower than they were in 2008. But the main fall in output is a fall in investment. Investment is the most volatile section of national income. That's the case for the core countries. But in the case of the less developed countries, Kindleberg makes the point that they are completely dependent on the core countries for their net export earnings, and that when these countries sneeze, they catch a cold. When the advanced countries catch a cold, they get pneumonia. And at a slightly later stage, you saw this crisis of the less developed countries, which, as they were called in Kindleberger's book, or the peripheral countries, which is what we're talking about now. And I think there are analogies that we can look at for that. Michael raised the question of Ireland, and obviously analogies can always be pushed so far that they break down. But we have a situation between core and periphery where you inevitably get winners and losers. You get countries that will buy more than they are able to sell abroad, and other countries, such as Germany, classically, which is able to sell their stuff hand over fist, and their main problem is finding people to buy it. So what they do is that they lend you the money to buy their stuff. And clearly, if I were to sell you this bottle of water, one of the easiest ways I could do it is I could lend you the money, so you could then buy my water. But I think you can see that that is not really a sustainable long-term plan. Me keep lending you money so you buy my stuff. And that, in effect, is one of the things that's been happening between the core countries in Europe and the peripheral countries as well. You've given us the classic example of that. You've got this trade deficit opening up, and at the same time this increase of foreign borrowing in Slovenia. That's classic. Now, that was a pattern also that you got in Greece, but also to an extent in Spain, Portugal, and Italy, whereas you have these winners such as Holland and preeminently Germany. But then there's a second pattern, which is the one that Michael referred to, where people bet the farm on becoming a financial centre. This is certainly the case in Cyprus. It's a case outside the European Union, in Iceland, a country, I think, of 300,000 people, where they have 14 times as much banking assets as they had national income at their peak. And also the case with Ireland, obviously. So there seems to be a bit of a combination of those two factors. Just to finish off, I mean, I think it is important to try and go back to the underlying causes and not, I mean, the surface phenomena are very important to us. We're struggling with the consequences of it, but we need to also understand the underlying causes, and not just that the banks are fragile. The banks are fragile, and that is important to us, but there will be crises of capitalism, whether or not the banks are adequately handled and regulated or not. But the banking crisis led to a bailout of the banks. The banking crisis led very quickly, it was the trigger for a fall in output, which of course meant a fall in government revenues, and then we got this crisis of state finance and the sovereign debt crisis. So that's the kind of sequence of events. So we're talking about a debt crisis, we're talking about a banking crisis, but fundamentally we're talking about a crisis of capitalism, and even if by some miracle, sitting in this room, we were able to sort the banks out and solve the problem of the debts, this will still be in the background waiting to bite us in the bum.
Yes, thank you. And I would just like to answer to your question. So, as far as the allocation of credit from the banks to the corporate sector is concerned, the interesting thing was that most of the credit didn't actually go just to finance unproductive.
For Michael or for anyone else?
Yeah, just for. Yes, it didn't. So this debt from credit from the banks to the corporate sector was not allocated just to finance unproductive activities, to finance the real estate sector. I mean, there was some credit allocated towards this direction, and there was also a lot of credit that financed very sketchy, leveraged buyouts. However, most of the credit that went into a construction sector was actually used to finance the core activities, to build roads and stuff like that. So that's it. And as for the problem of the bad bank, I think it is rather a similar situation as in Ireland. And there are a lot of problems, of course, with the Slovenian debt bank and the plan that was made by the government to go with it. Namely, the first problem, of course, is that this is really a costly solution to save the banks. I mean, if the banks were to be directly recapitalized, this would cost much less than it costs now when the bad bank is built. And of course, the problem is also that if you recapitalize directly the bank, you get ownership in return. While if you just cleanse the bad assets from the banks, not only you don't get anything in return, but you subsidize the private owners of these banks. And the other major problem with the bad bank is, of course, the plan that was made actually explicit by the authorities, that these assets that were taken over are about to be sold in approximately a 5-year period. I mean, maybe they will prolong. They will have to prolong the process. However, the intention remains clear. And also, it was explicitly mentioned that I mean, the banks, after being cleansed, are about to be sold, basically privatized, and these are the core problems, according to my opinion. So.
It is. I always like to hear analysis of Slovenian economy, because it was celebrated as an exceptional transitional country for such a long time. It had its own pattern of development, you see, and it did something that the other countries did not do. First of all, it managed to keep the banking sector mostly in its own hands, and so it is kind of interesting to see that we started off the transition period with this great divergence, but now, after the crisis, Slovenia and other post-socialist countries are now converging to the same point. I mean, pressured by probably the same forces of international financial markets. And so, this, I think, speaks volumes about the nature of transition, I think, because the transitology literature always emphasized that if you were smart and you did the right, and you chose the right policies, and you went on with financialization and privatization the way the IMF and other institutions said you should, then everything will be fine. And now we see this entire region, this periphery, Slovenia, periphery outside of the Eurozone, really going astray, really moving to a point of no return, I would say. And the only difference when we compare the Eurozone periphery to this periphery outside of the Eurozone is that these countries are not structurally important for European monetary union. So they don't get as much press and as much political attention as, say, Greece or Spain. But the situation is, when you compare, say, Hungary and Greece, or Latvia and Greece, are in terms of social cost and just damage to society is basically the same. So in comparing just the banking sector or just the financial sector, you don't get the whole story. That's my point. The whole question about how the banking developed in these countries should be related to the analysis of the overall transitional trajectory, and then you can get the full sense of what is going on here. And I would say, in relation to what Michael just emphasized, some similarities between Ireland and as a European, as a Eurozone periphery and these other economies, they really do exist. I mean, in many of these countries you had credit growth which then enabled housing bubbles. And this is classical story. So when I would say this is the rule. Whenever you have interest rate differentials, bank will seek the way to exploit them. And then it's just a matter of the infrastructure of the country and its economic history, how did it develop before, and that will kind of set the agenda of the banks, what segment they will try to exploit. So if you have some kind of, say, historical relations with Germany, as in Poland, then you may have some, looking at the composition of capital inflows, you may have somewhat more of direct foreign investments in semi-finished goods, German and other companies trying to take advantage of cheap but educated labor force. And in other countries which are more peripheral, geographically speaking, the only thing that presents a clear profit opportunity is basically the growing construction sector and expansion of credit in the household domain. So the point would be, I think, that this entire region, not because it's small, not because it lacks economic productive potential, but simply because it is not a part. It is not a part of this first stage of Eurozone integration. Is left somehow outside, and it just suffers the consequences. And you can see this when you analyze currency relationship. In as much as the only thing worse than euro for a peripheral country is an informal tie to euro. So all of these countries which are not in the Eurozone suffer the consequences of the internal contradictions of Eurozone, but informal, through high degrees of Euroization. And so you have the worst of both worlds. Right? You are not a part of the monetary union, but you suffer all the consequences, and you bear all the additional risks of not being a part of the monetary union. And I think that's the basic conundrum for these countries. And I think the crisis started more than 5 years ago, and it is still present when you look at this really weak growth rates or even prolonged recession in countries like Croatia, Serbia, and others. So they're really stuck in one place, and that was my point in the presentation. The only thing that ironically works in this very narrow, capitalist sense, is the banking sector. It works because it is foreign owned and it has the ability to borrow from the parent bank and so on and so forth. And so this is the only efficient and productive segment of the economy. But the other stuff is simply not. It's simply not there. It got lost in the falls of privatization and the crisis.
One question on Sasha's presentation. At the end you said that, of course, putting up a bad bank basically subsidizes the private owners. But I'm not so familiar, but as far as I understood, the major banks from where assets were put into the bad bank in Slovenia were public banks, or at least publicly owned, whatever that means. So that means we are basically shifting within the public budget some assets from one bucket to the other, but in the sum it doesn't immediately benefit a private owner. Or did I misunderstand?
Yeah, of course you're right. The assets that were taken over right now from two of the biggest banks in Slovenia, namely Nova Ljubljanska Banka and NKBM, both of these two banks are state-owned. Around 90% of NLB and 90% of NKBM are state-owned. But yes, I wasn't referring to, the subsidies to the private sector at large. But nevertheless, there is a certain amount of private ownership, private investors that are being.
Do the banks, these state banks, have private bondholders and emission bonds?
I guess, yes.
Well,
It's not very big.
to answer the first question, it's a bit more complicated because up until, let's say, 3 months ago, or let's say 1 year ago, even the Ljubljanska Banka was not entirely state-owned. The state had a major share, but there was a large share of KDC, Belgian bank, up to, let's say, at that point, 22%. Then it had to disinvest because the European Commission ordered it to do so, because it was itself bailed out. Now, what happened later, this was at the end of 2013, was that the bail-in principle was used. So that at the moment, the current shareholders, the current owners of the equity of those banks, were disowned, so to say. If you were a private owner, let's say the second largest bank, the Maribor Bank, was actually had a majority private, was majority privately owned by small shareholders mostly, and they lost everything. So these banks are not 90%, 100% state-owned at the moment, because it was the Slovenian state which recapitalized them. But to return to the question of subsidizing private owners, if you have a bank where you have, let's say, 10% of state ownership or 0% of state ownership, and then you have 90 or 100% of private ownership, now at the moment this bank needs to be recapitalized, let's say, and it gets to the financial market and no one will give it money. No one would like to invest. So the state comes in. And if the state does not disown the other owners, then it rescues their equity. Their equity would be worthless, they would lose everything, but in that scenario of the bailout, they will of course lose, they would not be 100% owners of the bank, but still their equity would not be worth 0, it would be worth, I don't know, 5 billion. So, as far as these hybrid instruments, bonds, subordinated bonds, as they are called, it's concerned. Yes, those people were also disowned.
And senior bonds?
Yeah, because you know that the European Commission is contemplating, or actually I think there might even be a directive about these kinds of instruments. If you use the bail-in principle, then the people of this so-called, these are actually normal bonds, IOUs, I would say, of course, with high interest rates, a bit riskier, but still, you know, in the normal, normally, the banks would have to go insolvent or bankrupt so that you would lose everything.
Yeah.
But in this case, because the state bails the bank in, these investors also lose everything. And it is a big problem. People are debating this today in Slovenia because, you know, the European Commission says the banks have to diversify their ways of financing. Not just by the ECB loans and not just by household and corporate deposits, but they have to issue their bonds on financial markets together, their financing. But who will invest in such papers now after this precedence?
And my second remark was actually about the EU entry and the Eurozone entry of Slovenia. If I'm perhaps a bit overestimating, but basically before Slovenia entered the EU and thereby became victim to free capital mobility and started to suffer from the downside of the already existing Eurozone, basically everything was fine. Is that a way to sum it up? And well, in some sense, I mean, we agree on that. The question is this public opinion in this country, or how far are you in penetrating the public opinion to convince them of that?
I mean, I was not trying to say that it was wonderful and it was all fine before
Well, it sounds pretty good.
but yes, I mean, nevertheless, it was comparatively better also from the point of view of the working class, especially since, I mean, not just that economy was a bit more balanced, that there was bigger macroeconomic stability, but basically workers basically enjoyed a higher I mean, rate of wage growth. There was high employment and welfare stayed intact. Actually, I mean, if we compare if we compare Slovenia to other Eastern European post-socialist countries, the countries that adopted the shock doctrine, I mean, of course, we can say that the case of Slovenia represents actually something comparatively better.
Slovenia didn't try to kill inflation in 1 year, as many other countries did, and I believe it had relatively high rates of inflation during the 1990s. And one of Slovenian economists called this Keynesian opening, as opposed to disinflation programs that were, or stabilization programs that were put forward in other European post-socialist countries, which of course, yeah, they reduced inflation to a very low levels, but they consequently killed the economic activity because the demand that was kind of afloat with this well, relatively high rates of inflation did not exist could not be sustained in countries like Croatia, Hungary, and others who were really I mean, not the country, but the political elites were really struggling to be good pupils of the IMF and other financial institutions. And so in that sense, I think the Slovenian opening was somewhat different, and it was definitely not done by the book. And so it was kind of it was a surprising outcome to see that after this great divergence, as I said at the beginning of the 1990s, after the transition depression between 1990 and 1993, we now all of these countries are now facing basically the same problem. Only difference is that Slovenia already is in the Eurozone, and other countries except Montenegro, which joined the Euro unilaterally, are still outside and trying to figure out what to do.
I have a question predominantly about countries with an extremely low amount of domestic bank ownership, such as, I don't know, Croatia, Czech Republic. What are their owners doing? As Marko mentioned in the screening example, the biggest foreign participant in the banking sector was the Belgian-based KBC, and yet the European Commission demanded from them that they had to withdraw from the market in order to receive bailout money. What is happening in the other countries? Are these foreign owners withdrawing on account of, in the last instance, to not enough profitability, or are they supplying money into their subsidiaries and so on? This is a question, I think, which is very important when one is considering European level solutions for the banking sector, such as, I don't know, Varoufakis and so forth.
Right. First of all, we have to understand that the expansion of foreign ownership in these countries is a part of the new strategy of the core banks, right? So I would say that they try to be, German and French bank, they try to be somewhat conservative at home, but predatory in these new markets. And so one of the reasons why they actually lend in Swiss francs is they all want bigger market shares. After the crisis hit, it appeared that they are pulling capital out, that they will, leave this area. But I've spoken to some bankers in Croatia, and they are actually saying, no, we are actually planning to stay. I mean, these subsidiaries like Erste Bank,
Austrian banks,
Raiffeisen, right. Except for Hypo, which is a special case of open corruption and criminal activity, the other banks are really not planning to leave this region. And the reason, I think, at least part of the reason, is the fact that we have in many of these countries banking oligopoly. So first four banks all have the majority of assets in terms of assets, or in terms of market share, and so and these are usually the foreign owned the subsidiaries, and so they don't have at this point reason to remove themselves completely. In Croatia, the segment that is somewhat in danger are the small banks that have been developing throughout this period, trying to do some kind of business, but having very little market share, very little influence on the process of creating this new institutional framework that should be put in place after the crisis. So I think that the foreign owners of the banking sector in post-socialist countries are looking to keep the status quo, to keep things as it is. As I said, their profitability is dropping, but it's not dropping so rapidly as that would worry the owners. And on the other hand, we have more non-performing loans. But again, in many of these cases, state is now moving in and trying to subsidize in one way or another to keep, like, the scenario in Croatia was after it was clear that we had a housing bubble, the government moved in and it actually passed a law that in order to subsidize any purchase of real estate that does not include some kind of old buildings or old houses. So if you are buying a new flat or a new house, newly built flat or a house, and this is your first property, your first real estate, the government will subsidize your loan, and that of course keeps prices from falling, because Now the demand is kind of stimulated in this way, and the banks do not have to clear their balance sheets in the way that they would if no government support was put forward. So as always, there is this public-private partnership, right? Especially in the cases in which construction plays a major part of your gross national product. Of course, government does not want to see it completely vanished, and they are doing whatever they can to keep it afloat. And this usually goes it goes in the same direction. It is usually corresponding to the interest of the banking sector.
It's the same thing in the Baltic states, which the banks are mainly owned by the Swedish banks, and the Swedish banks pumped up the money to keep all the Baltic subsidiaries going. So it's not a big expense. The Baltics are small, the Swedish banks can afford lower profitability to make sure that those banks survive. But what European banks have done is to withdraw their lending between two different banks that they don't own, both inside the Eurozone and of course into the emerging economies. So that if you look at the data, European banks are the biggest withdrawers of credit to the emerging economies, where they've been lending in the past in a big way. They've now been either reducing that lending and not re-lending, so that unless it's a subsidiary, so they can't. But otherwise, they've been reducing lending that way. That's how they've been reducing their risk. So emerging economies are finding a squeeze on credit on some of the emerging banks because of the European banks' withdrawal.
Is that combined together also with their widening of the market? I mean, are they trying to push out the local banks?
I think it's more that they're concerned to make their own risk asset profile look better, and they're concerned about the state of some of the emerging economies. And that's the solution they've come up with. While preserving their subsidiaries where they've got them, they've withdrawn the interbank lending process as much as they can.
Any other comments or questions for anybody, but not just for us, but for anybody, for our guests?
I wanted to compliment Philip for lucidly understanding and summarizing what used to be, I would say, a ruling ideology, or maybe an important and strong ideology, political ideology of Slovenia, namely this first 10 to 15 years of transition were sort of an object of national pride, I would say, also. Because you have to understand that there was at least 15 or, yeah, I'd say 15 years uninterrupted convergence with the core European countries in terms of GDP, or real GDP, GDP per capita, and the other things that Sasha mentioned. Now, what is, of course, even more important at the moment is the question of the euro. Could we blame euro for cutting off this, or for doing it this successful model? And it is quite peculiar, but I think, at least as far as I'm aware of it, there is no such discussions in Slovenia at the moment, even by the people who have criticized European Monetary Union as an example of a bad currency union, of a union that does not have conditions for it to be an optimum currency union. Even they, who were supposedly Euro-skeptical, are not using this argument at the moment. Now, what I also wanted to say about this first period of convergence, just in order not to glorify it too much, it was not able to achieve something very important, in my view. It did not enable full employment. or it did not even came close to full employment. It came to, let's say, 6% unemployment in terms of labor force survey. But that was a really poor record if you compare, for instance, if you compare it with the socialist Slovenian economy, which had for 40 years of almost full employment. I mean, 1.5% of registered unemployment, this is full employment, if you ask me.
In Slovenia.
Yeah, no, that is the textbook example of full employment, because of course you have some people between jobs and looking for jobs, and this is a situation.
Just Slovenia as a republic.
In Slovenia, I'm saying in Slovenia, in the Republic of Slovenia, in time when it was still the socialist economy. So this is one very important indicator that should be pointed out. Now, I'm moving now back to the euro and to the comparisons which were made here between the case of Slovenia and we were speaking about Ireland and some other countries. One very important similarity or comparison is Portugal. We don't hear a lot about Portugal in these parts, but it was brought to my attention by an article by Olivier Blanchard, who is very famous now, chief economist of the IMF. Everyone in Slovenia knows him by now, for now. He became something of a, he penetrated to mainstream media because of his findings that the IMF's coefficients, multipliers were too low. Now, but that's not important for this discussion. So, what he revealed was a certain pattern that happened in Portugal from, let's say, 95 to 2003, which resembles very closely what happened in Slovenia. Now, in Portugal, Portugal entered the ERM2 mechanism, and also later, 2 years later, or 2 years later, it adopted euro as its currency. And what happened was that unemployment went down, but the economy was overheating, which was reflected on very high current account deficit. In 95, they had zero current account deficit. In 2003, they had more than 10% of current account deficit. So the economy was overheating, investment was booming, and so on. And you can see it in the charts, in the figures. And then I went to the case of Slovenia and tried to map the same, those same indicators, and it revealed the same pattern. And in the same point in time, I'm not saying chronologically, but at the moment when Slovenia entered the ERM2, and then the European Monetary Union, this was 10 years, a bit like 10 years later than Portugal, the same pattern was experienced. Current account deficit from 0 to up, and unemployment also went considerably down. And also another similarity, then there was a crackdown. In Portugal, it was in 2003, there was a recession, minus 1% growth. That was in time when every other European economy was in considerable growth, so that was a severe crisis. And in Slovenia, it happened in 2009 because, it was just a coincidence that it was exactly at the moment of the global crisis. So my working hypothesis is that those are two very distant economies with different characteristics. I would imagine that Portugal has less manufacturing sector, more stress put on the service economy and stuff like that. It is a much larger country, 5 times more. The population is about 8 to 10 millions. In Slovenia, 2 millions. Different history, formidable colonial power, special ties with England or Britain, etc., etc. Slovenia itself more of a semi-colonial possession of Austria, etc., etc. So, but there is one thing in common, and this is that they entered the Eurozone and the same pattern happened. So, when we were discussing the deeper, the more fundamental causes of the crisis, I would say that in this part, the adoption of the euro and the abandonment of autonomous monetary policy was a profound moment of change. It dismantled the existing macroeconomic framework, and those economies reacted with massive overinvestment, errant overinvestment, indebtedness fueled by debt, and at some point a crash. And what is even more important is that this is not only cyclical, because Portugal never really recovered from that crisis of 2003. And it got hit pretty bad by the 2009 crisis as well. We know what's happening there. And what is happening is that it is stagnating in terms of development, socio-economic development. This country is pretty much where it was, or it is even
Worse,
yeah. There are East European countries catching up with it, even like Czech Republic and Slovakia, in some indicators, large inequalities, stuff like that. And what we're fearing is that it's happening, the same thing is happening here in Slovenia. But this is not only cyclical, of course. There will probably be slight growth of GDP this year, and even more growth next year, and so on and so on. But will there be recovery of jobs? Will the welfare state survive this? Etc., etc.
We have 5 more minutes if anyone wants to comment on what Marco said.
Well, the way what Marco seemed to be saying to me, that we have the purpose of the European Monetary Union is to bring about convergence between the periphery to the core, so that we have one big unified, equal capitalist federal state working with growth more or less at the same level, and the gap between the capital GDP narrowing and everything. But in fact, what has happened is not. It's divergence in the period. Limited periods of convergence trying to force themselves into the straitjacket. And then once inside, the whole process is divergent because capitalism is uneven and combined. That what you get is a big boom of investment into these areas where they can exploit the labour force, there's cheap credit and so on, and you get an expansion there, so you get the thing is out of clink. It doesn't work in one harmonious way. Now, of course, no capitalist economy works in one harmonious way. In the UK, we have areas of the north of England which have got massive unemployment compared to London, where you wouldn't think there was a recession. So you've got huge differences between different regions. And the thing under these capitalist states, and the same with the US, with its federal union, is that these processes do not converge except for very small periods, maybe when things are growing in general. But when there's any problem, you see huge divergence. And that's so that the process of, it's not just that the monetary union is a suboptimal currency union, it's that capitalism works in this way. It's not, you have divergent processes which really counteract the centripetal forces which the elites are hoping are going to work and produce a unified state.
So I guess we can end this workshop right here, and we will continue at 5 o'clock with the second workshop on the socialization of the banking sector.